Hi class. In this video we are going to look at some examples from chapter 21. So this first one says Char Corporation had outstanding 220,000 shares of $5 par value common stock. That was on August 13th, and then they declared a 10% common stock dividend distributable for stockholders on record on September the 1st. Estimated fair value of the shares was $25 per share, and then we are to do journal entries. So let's see. We know that when they declared that dividend, they're giving common, or they're intending to at a future date, they're going to distribute common stock to the current stockholders, or the stockholders on record on September the 1st, I believe. And the value of that stock is actually more than the par value. So we're going to be dealing with some paid-in capital in excess of par. That's for common stock. So I'm going to go ahead and plug that down there. We also know that those dividends are going to decrease our retained earnings. And we have declared a common stock dividend. So that is a dividend distributable. Make sure I got those in the right place. So these are the three accounts you're going to be working with. You're going to distribute common stock. There's going to be some paid-in capital, and that's going to decrease the retained earnings because we are decreasing the amount of capital in the company when we issue dividends. So let's see, our dividend distributable, we're going to calculate that amount based on the par value. So it says they had 220,000 shares outstanding, and they declared a 10% dividend. So you're going to take the 220,000 shares times 10%, and that's going to tell you how many additional shares of stock they're going to issue. So they're going to issue 22,000 shares of stock as part of this stock dividend. So 22,000 shares at $5 a par value is $110,000. So that's actually the par value. Get back down here. That's the par value of the common stock that they will be distributing on September, whenever it was, September the 15th. Okay, so then we have to calculate the excess value. And it says the fair value of the stock at that time was $25 a share. The par value was $5, but the value was $25. So $20 of that fair value is actually the amount that's in excess of the par value. So $20 per share times the 22,000 shares gives us $440,000 in excess capital. And then the retained earnings, that would be the decrease, would be the 22,000 shares that you're going to distribute times the fair value of $25 is $550,000. So I actually calculated that paid-in capital. If you wanted to, you could calculate the retained earnings decrease, and that's very much like when we calculated how much cash a company was going to get when they sold a common stock. You just take the number of shares times the market value. So you could calculate that retained earnings, could calculate your common stock dividend distributable at par value, and then you could just kind of plug in that credit amount that brings these two in balance. So you could do it either way. So let's check and make sure I did my math right before we dig into this question any deeper. All right, so then entry number 2 says, record the entry on September the 1st. So when it says on September 1st, they declared that common stock dividend distributable on September 15th, which is the date they're going to distribute the stock, but they're going to distribute it to stockholders on record on September the 1st. So September the 1st is the day that they're going to basically make a list of all the people they owe stock to. So there is no journal entry required for that. They're just going to make sure they have the data so that they can issue the stock to those people. So there's nothing that's going to affect the journal in that one. And then on September the 15th, says that's when their dividend will be distributed. So to do that, let's go back here to the first one. In this entry, we have a common stock dividend distributable. We've decreased our retained earnings, and we already calculated our paid-in value in excess of par. Now, the retained earnings is going to be decreased, or it was decreased at the moment we declared those dividends, and there's nothing else we need to do to that account. Our paid-in capital, we're not going to make any other adjustments to that either. Because it doesn't say anything about it being distributed later, nothing like that. It's just in that regular paid-in capital in excess of par account. It's this common stock dividend distributable that we need to take care of. So we're going to take that $110,000 out of common stock distributable. Common stock dividend distributable. And we're going to put that $110,000 into the common stock account. So we're just basically changing into that as a out of a distributable account and putting it in the regular common stock account. So when you finish that, this should be well, there's two entries and then that one that has no journal entry required. So let's look at another one. Okay, this one says on March 31st, Elephant Corporation had outstanding 100,000 shares of 7% common stock with a par value of $10 a share. The stock was originally issued for $12.40 a share, and then on that date, the corporation repurchased 20,000 shares of the preferred stock, and they paid cash of $12.20 per share for the stock. So in this case, we are recording the entry for a repurchase of stock. That stock is treasury stock, and we're paying cash for it. So, like I always start out with the one I know we're paying cash. And now when we issue stock, whether it's common stock or preferred stock, we credit it. When we repurchase stock, it would stand to reason that we need to debit something. But instead of debiting preferred stock or common stock, which it was preferred stock that we repurchased, we're going to call that treasury stock. And so there would be a treasury stock account for preferred stock, one for common stock, but in this case we're buying by preferred. So when we repurchase our own stock, so this is stock in the Elephant Corporation, so they're repurchasing their own stock, we're going to use the purchase price. So it says they repurchased 20,000 shares at $12.20 per share. So we're just going to multiply that. So they actually paid out $244,000 for that stock. That amount goes into the treasury stock account. There is no paid-in capital in excess of par that you have to calculate when you're doing treasury stock transactions. You're just going to record the treasury stock at the purchase price. So when you're doing that, when you get finished, you should have something that looks like this. So that's fairly simple. I just wanted to show you that because it's different than actually issuing stock. Doesn't quite reverse that entry, because when we issue stock, we get cash, we credit either common or preferred stock, and then if applicable, we would credit paid-in capital in excess of par. So we don't just reverse that entry when we repurchase stock. It does look a little bit different. So that is an example of a treasury stock purchase. The rest of the problems in this chapter are fairly similar to the examples in this video, but of course, if you have any problems, let me know and I'll try to help you out. Have a great week.